Hey guys, happy Friday. It's October 11th. Giving you your market update for the week. We've got a couple of things to talk about on inflation, some things that are going on in China, as well as technical signals, of course, and where we're at with interest rates. So interest rates are up a little bit this week, not by much. We're going conventional, gone from 6.33 to 6.403, and FHA 6.021 to 6.185. So they're continuing their trend a little bit and going up. As we mentioned, interest rates are not going to come down in a straight line. So, it's just not going to be consistently down. We are going to have some corrections where the, bond traders are going to have some opportunities to take profits, move their numbers around a little bit. So we're going to have some buying, some selling, and then, interest rates are going to adjust. But as we get the news, we're going to have those adjustments in interest rates. So this week it was the inflation numbers, CPI and PPI both came out a little bit higher than expected. Now, the thing that is keeping those numbers high is the housing, basically the shelter cost that's in those reports. And we do know that those are lagging numbers, so they're 9 to 12 months behind. So we know that those numbers are coming down still. But when we do these month over month numbers, we have to keep in mind that they're replacing numbers from a year ago to average out in the total numbers. So months are going to have an effect on the annual number, and some months are going to be a little bit higher. And there's going to be some movement on it. Okay. So that's what we're seeing this week. And then, we do have some additional inflation concerns that we need to talk about as well. On the inflation front, of course, we have the CPI and PPI reports, which, those numbers are going to fluctuate. We just mentioned that. And the bond market isn't entirely sure on, that inflation really is under control. And we've been seeing that a little bit in the trading where we expect certain things to happen and they just haven't happened. But now on top of that, China just announced that they might be doing or will be doing some additional stimulus to help their economy. And we all know that stimulus is inflationary because you're printing money, you're basically creating something out of nothing, and then that has to be paid for eventually, and that's going to have an effect on possibly some bonds and treasury yields. So depending on where China puts that money, if they put it into equity markets, then that could affect the yield on our equity markets as well, that we have to pay a higher yield to attract buyers to buy our debt as well. Mortgage-backed securities are debt, right? Treasuries to pay for government spending, things like that. So we have to attract those by paying a higher yield, which means we have to pay a higher interest rate on any kind of loans that we have. So we're keeping an eye on that, and we'll have to see how that all plays out in the next week or so, depending on where China, puts that money and how much. But part of that is also they've been doing a lot of stimulus, so we're not entirely sure how big of an effect it's actually going to have. We'll just have to see how it all kind of plays out for us, in the coming week or so. So that's the news portion of what's going on with interest rates and mortgage bonds, mortgage-backed securities. Now, what we can look at and track and have a better idea of what's going on is, of course, the technical signals. So with the technical picture, when we're talking about traders and when they're going to buy or sell mortgage-backed securities or bonds or treasuries and so on, that's looking a little bit better for us. When we hit floors of support, then the price is basically trying to figure out if this is where they want to stay or if traders are going to continue selling and go below this. Usually when we hit different levels, that's going to take some sort of news, like China, for example, like saying something that is dramatic that could cause us to go below that level of support. But we're not really expecting that. And over the last week, while interest rates have ticked up a little bit, the technicals have tried to flatten out and find a floor. So we've been watching it, trying to see exactly where that floor is going to be. It looks like over this last week, we've kind of leveled out a little bit. That's why interest rates only went up slightly from the beginning of the week to now, where technicals are kind of supporting the trading prices, supporting that we stay where we're at. And if we can stay here above that level of support and bounce off of it, which is kind of what we're expecting, assuming we don't get any crazy news that's going to cause us to go below that, then we should see interest rates start to gradually get better again from here. So this is that, staircase with mortgage-backed securities kind of, selling off, and then they come back and, it moves up and then flat and maybe a little bit down and then up and then flat and then up and flat. So we can see interest rates actually get better, then a little bit worse. So we're better by a quarter, then we're worse by 1/8%. Then we're better by a quarter, then worse by 1/8. Better by a quarter, worse by 1/8. So it's continually slowly getting better, but it's got to, find its footing every time it goes to this next level. So hope that helps you guys in your conversations. Know that interest rates, while they did tick up a little bit, they're still lower than they were, of course, a year ago, or even just a few months ago. And we're going to see them continue to get better. It's just going to not be in a straight line. So have a great weekend, and if y'all need anything, feel free to reach out to us. We're here to help.